enhanced understanding of what the main policy questions are on a topic, create public education around it, and also to provide a platform for discussions and better policy choices. So for about close to 2 years now, the IEA, with some support from the Hewlett Foundation, has been working together with the Urban Institute, a think tank based in Washington, D.C. And what we are trying to do is to try and create opportunities for the Commission on Revenue Allocation to perform its roles better. And one of the things we thought we ought to do, in addition to others, was to try and build a model that allows for the forecasting of revenues so that the CRA's intervention in the revenue distribution process is based on facts, but also helps to keep the Treasury and the Kenya Revenue Authority more honest in those discourses. In order to achieve that, we were required to together build a history of the collections and by each taxer, in addition to which we would look at what the forecast stated and what the reality would be when the taxes came in. We found, of course, that there have been some significant differences over time. And as we're trying to bring that model, one of the things we are here asking ourselves today is how do these differences in forecasts affect the ability of counties to execute the functions that is provided to them? Because we've seen that on the part of the national government, we've had increasing revisions of the budget through supplementary budgets. Last year alone, I think we had 4 supplementary budgets, one of which was passed right after the new financial year had started. So that's basically the reason we are here. So my colleague John, Noah, and our colleagues from the Urban Institute have put together a presentation, basically based on some paper that they're writing, and it's titled Issues in Revenue Estimation in Kenya and What Are its Implications for County Level Budgets. So I'd like to make a request to all of us, so specifically to Abraham and Javi, please keep your cameras turned off so that we can have the presentations made. Please turn off your cameras. Abraham, please turn off your camera, and Javi, please turn off your camera as well so that we can have the presentation made by John and Noah going on. Javi, could you turn off your camera? Abraham, please turn off your camera. Abraham, please turn off your camera. Yes, Javi, could you turn off your camera as well? We can still see your. Can you hear me, Javi? Please turn off your camera so that John can beam the presentation. There's a on the toolbar right at the top. Thanks. It's back again. Abraham, please turn off your camera again. And Javi, we can still see you. Sorry, gentlemen, I think this thing is easy. Yes. Javi, you're back on. At the top of your toolbar, on the menu, there's an icon for cameras. Please just click it once so that we can get John's presentation going. Are you there, Javi? Just right at the top of the bar, somewhere to your right. Yes. And Abraham is back. Abraham, please switch off your camera again. Abraham, could you do us a favor and switch off your camera? Yes, thanks. What about you, Javi? You're still on, Javi? Just switch it on. Click the camera icon just once. Just once. Okay, it went off and then back. Oh, okay. Javi and Abraham, you're still back on. Please, please switch off your cameras. Happy, you're still showing. Your camera is still showing. Would you switch off turn off your camera? It's right next to the icon for your microphone. I think to the left. To the left. Yes. Oh, it's back. I'm not too sure. Okay, thank you very much. So, John, please go ahead.
Okay.
John, you have a lot of background noise. Please make sure you're in a quiet place. Thanks.
Okay. Good afternoon and good morning to our colleagues from the Urban Institute in DC. Let me turn off my camera. Yeah, my name is John Mutua. I work at the Institute of Economic Affairs, as was introduced by Kwame, as the head of Public Finance Management Program. And I also work as a programs coordinator. So I'm going to make this presentation on behalf of the PFM team, Public Finance Management team, as well as our colleagues from the Urban Institute. The PFM team comprises of Noah, Wamalwa, Darmi, and Raphael Moya. And we have our colleagues from the Urban Institute, Rihanna, Raza, and Javi Galpa. So as a way of introduction, and just to mention that as part of the joint project that we are undertaking, Kwame introduced the project. It's basically about bringing evidence to bear and using that evidence to use it to improve Kenya's decentralized system of governance, especially towards influencing the division of revenue process, and basically elevating public discourse and debate around the issues of division of revenue and equitable revenue sharing. Now, in the recent past, we've seen lots of media debate and interviews from governors, from COG, and there have been complaints and mainly complaints around issues of delayed cash to county governments. We've also seen media reports on issues of missed revenue targets. Now, these two news items were actually, and of course, there's been a bit of a discussion in social media pages, mainly on Twitter. And so these are the main things that actually motivated us to share some findings from some study that we are doing. We are undertaking, as was introduced by Kwame. And so what we are presenting today, as you can see from the outline, we'll be looking at issues of revenue forecasting, as was mentioned, and its implication for county budgets. Now, at the onset, in the joint project that we are undertaking, we are currently developing the revenue forecasting model together with the Urban Institute. And in development of this model, which is a data-intensive exercise, we, as a prerequisite, what we did was first to examine the accuracy of revenue forecasting. And in doing that, of course, we did some analysis. And so this analysis is what I'll be presenting, just to get some insights on the history of revenue forecasting. And so we put data together. We had data running up to 1995, but because of challenges, the data that we've used is from 2014 to 2019. And so I'll be presenting this data just to demonstrate some of the issues around revenue forecasting accuracy, questions on revenue forecasting, and then of course move on to its implications for county budgets. And in this, what I'll be touching on are specific things related to delays in exchequer issues, implications around volatility in planning that arises because of these delays, and some adverse effects on county development programs. And of course, conclude with a summary. And of course, the summary will highlight two main things: the fact that national budgets are maintained, and this is contrasted by cutbacks in county spending. So, in a nutshell, this discussion will show the fact that given these macro issues, especially on revenue forecasting, they have an implication on decentralized system of government, and in particular, just helping with regard to the issue of enabling county governments to be able to function as provided for in the Constitution, and to be able to deliver services to the citizenry. Now, so what you see here is basically just a trend of ordinary revenues. So I'm starting off with just showing a trend of ordinary revenues, absolute figures. These are figures from 2014-15, and we are comparing revenues as in terms of budget estimates in comparison with actual revenues that were realized in those financial years from 2014 all the way to 2019-20. And you can see, of course, in absolute and in nominal terms, there's been an upward trend for both ordinary revenues in terms of budget as well as in the actual revenues that were realized. And these are figures in billions. So you can see in terms of budget, it's 1.08 trillion, whereas for 2014 and the actual revenues realized was 1.032. So if you compare those two, you can see actually from a visually that this gap between the two has actually been widening. In 2019, 2020, of course, there was a dual effect of COVID actually, and of course also the performance of the economy. And you can see the revenues that were realized was 1.57 trillion compared to the projections for that financial year of 1.88 trillion. Now, looking at those trends, we computed errors in revenue forecast, and for one to do this, what we did, we used the National Treasury's budget review and outlook paper, and in those documents they usually provide information on revenue forecast. So there is a forecast based on when the paper is presented. So if you look at the budget cycle, this paper is presented in September, whereas the budget is usually tabled and approved by end of June. So there is a period of almost a gap of nine months. And by the time the budget review and outlook paper, the BROP, is presented, it usually provides some projections. So for instance, the BROP for 2019-20 usually has information on the projections for revenue, that is for the budget for 2019-20, whereas the previous BROP, 2018-19, what we are calling the year ahead, so the previous budget review and outlook paper document will provide projections for the year ahead, which is 2019-20. So we compared those forecasts on revenue based on the BROP forecast as well as the budget, and compared those respectively to the actual revenues. So we had, of course, data for revenues, just as I presented in the previous slides. And you can see the errors actually. The errors have been going up based on the budget from 5% to 19%. So the negative basically shows bias in revenue projection. And then the same applies to projections based on the BROP vis-a-vis the actual revenue. That also increased from 6 to 11, then there was a slight drop, and you can see the trend there. So basically, what that diagram shows is that errors seem to be systematically systematically overestimate revenue, in the sense that the revenues that materialize, or the revenues that we've collected for those 6 financial years, is less than what was projected. And you can see the errors, the proportion of the errors from 5 to 19%. It's just basically that gap between actual versus the forecast. And the second thing to note is that these errors do not seem to fall consistently. So for instance, as you can see from this first slide, there is a small drop in 2016-17, but the errors have been increasing. And then, of course, if you look at the average of this, it shows that the forecast based on the budget, actually the average was 6.1 in terms of the errors, and compared to 4.4. Now, what one would expect is that the budget being a more recent document, that its forecast would be more accurate. So the gap between the revenue forecast based on the budget should be smaller than what we are seeing. But what the data shows is that it's actually larger than the BROP forecast. BROP forecast on average was 4.4, whereas for budget was 6.1. And of course, we also did some root squared means, and they also show that again the error was large with the budget forecast. Of course, for 2019, what you see there is that as much the error is actually the largest. It's large in it's the largest in 2019-20, and this is obviously in part attributable to the effects of COVID pandemic. Now, of course, when you look at the revenue forecast errors, the question to ask is whether the economy has an effect on this, whether this is actually induced by the underlying economic forecast. This is basically showing the same story, again the trend, but as a share of GDP. And you can see, for instance, for actual revenue, this has been declining from 17.7 to all the way to 15.4 in 2019-20. But this is what I'm referring to, that what we also did was just to basically check whether these errors are attributed to the underlying economic forecast. And here we used, of course, GDP forecast. And again, looking at the forecast, comparing forecast based on BROP vis-a-vis forecast based on the budget, and we compared that to the actual GDP, it also shows that there are actually what it shows is that unlike revenue, the GDP forecast is actually pessimistic. And what this means is that So it's for 2014-15 all the way to 2017-18, it's positive. So what this means is that whereas for revenue we overestimated, but what was realized was below what was projected, it is the reverse for GDP. GDP was underestimated, but we ended up realizing more GDP figures based vis-a-vis the projections for GDP. With the exception of the two last financial years that shows some underperformance in GDP. And basically what this means actually from this data is that there is little evidence to suggest that the error is actually emanating from our estimations of the economy. So what basically this means is that GDP forecasts do not systematically account for the errors in revenue forecast. Now, this again just basically shows errors in revenues over GDP. So this, what we did was basically to use these figures here and deduct, for instance, ordinary revenue as a share of GDP based on the year ahead of drop, and deducted that from actual, and also did the same for the budget, 19.3 minus 17.7, and basically talks about the same story, shows the percentage point differences in terms of the errors. And again, what this means is that even in the past 2 years, when GDP was overestimated rather than underestimated, the GDP error does not account for the revenue error. So it basically confirms that from the errors in revenue over GDP as a ratio of GDP. So again, revenues were still overestimated in the past 2 years, even as GDP was low. So this basically confirms the same story that there's very little evidence to show that the errors that we are seeing in revenue projections are actually attributable to GDP forecast. Now, from this picture on revenue for forecast and the errors in revenue forecasting or revenue projections, there are obviously certain implications that arise from this. And the main implication is obviously the issue of revenue shortfalls, given that what was projected based on the two projections, drop and budgets, for revenues was higher than what was realized. Now, this has implications for county budgets, and this is what we are going to demonstrate based on the data that I'll be showing. Now, I'll try and move a little bit faster. Now, we have this data on actual revenue inflows. Now, it's quarterly, again, for the same 6 financial years. So you can see Q1 all the way to Q4 for each of the 6 financial years. And what it shows, theoretically, the collection that is expected in each quarter is 25% out of the total. So for each quarter, the ideal target is 25%. So you can see across board, the averages are shown there. Q1 is 24, Q2 hit the target, Q3 was slightly less by 2 percentage points, and there was that compensation in Q4. But it's more or less even for the 4 quarters in terms of how money comes in at the national level. Now, the discussion, of course, on issues of revenue is that revenue division between the 2 levels of government to facilitate budgeting is actually based on the revenues that are generated at the national level. And if we get it wrong from that stage, it obviously has implication, and this is what basically we're trying to show. Now, how money comes in is actually consistent or evenly across the quarters. How money comes in. However, comparing that to the outflows in terms of the releases, exchequer releases to the national government as well as to the county, gives a different picture. So there's a mismatch between how money comes in and how money is released to the two levels of government. Again, looking at the averages from Q1 to Q4 for the 6 financial years, at the national level, the picture is not so bad. It's only in Q1 where there were some delays because it's less than 25% by 6 percentage points. But then it picks up in Q2, 3, and then there's some compensation in Q4. This is contrasted by what you see in at the county level. Q1, the average is quite low, 10%. So basically showing that counties are bearing the brunt actually in terms of the releases. Now, if you zero in on the counties, comparing recurrent and development, we see that the picture is more pronounced. It's more problematic at for development budget. For the recurrent budget, again, more or less slightly even 25, slightly some delays in Q1, but the challenge is glaring at the for development budget. Now, those graphs basically shows delays in exchequer issues or what is called releases of funds to the two levels of government. So whereas revenue or inflow of cash is fairly even across quarters for the 6 financial years, as was demonstrated in the first graph, there is actually a mismatch between the two levels of government, and the delays fall disproportionately more at the county level vis-a-vis national level. But when you look at the county between recurrent and development, it's more at the development for development budget. Now, the other thing that arises from the delays in releases of funds is that counties obviously are forced to basically revise or adjust their budgets in order to reflect the realistic revenues, of course, against the expenditure. So what this thing, the issue of delays in release of funds does is basically it leads to budget revision, which obviously has an implication in terms of affecting or disrupting planning and budgeting processes. Now, we combed through all the budgets for counties, for the 47 counties, and this is basically just a summary of the revision. So this table basically shows the frequency and the magnitude of budget revisions for all the 47 counties between 2014-15 to 2019-20. So you have a summary. So the frequency is just shown by the number, and the way we computed this is that revisions are actually based on Q1. So in every financial year, we have 3 revisions because they are referenced or anchored on Q1. And if you multiply that by the 6 financial years for the 47 counties, the possible number of revisions is actually 846. But what we are showing there, we have 835 because there were 11 cases of counties that did not have their budgets approved until Q2, and hence the difference between 846 and 835. Now, the revisions are obviously either upwards, that is positive revisions, or downwards, shown by the negative revisions. Now, the summary here shows that, or where there is no change, and this is actually based on the budget that was approved. Now, there are more cases of no change, 61 for recurrent and 53 for development. What this shows is actually that that recurrent budgets are more stable than development budgets. But in terms of upward revisions, it's more or less similar. But what we had were more downwards revisions for development vis-a-vis recurrent. And the third column just shows the magnitude. So without looking at the direction of the revision, the magnitude of revisions based on the monetary value, the quantum, for development was 15.7, based on the approved budget vis-a-vis 5.8 for recurrent. So basically, there's more movement or in terms of revisions for the budget, for the development side of the budget. Now we also just try to understand the intergovernmental fiscal structure, and what we did was to put together the different sources of revenue for the national government vis-a-vis the different sources of revenue for the county budgets. And I'm just trying to look at so this is basically an extraction. So the idea is that all the total sources of revenue we try to map that to the uses of funds at each of the two levels of government, as a way of basically showing the intergovernmental fiscal structure. And so the idea is that all the sources of funds at each level should actually match the total uses, including, of course, the opening balances and the closing balances. So, for instance, the sources of funds at the national level are obviously the tax revenue, non-tax revenue, the money that we borrow from the domestic borrowing, external loans and grants, as well as all the balances. Whereas the uses at the national level is money that goes to all the ministries, departments, and agencies, money for debt servicing, what is called the consolidated fund services, and also the transfers to the counties, both conditional as well as equitable share, as well as the closing balances. All those would comprise the uses of funds, and they should equate. And we did the same for the counties. The counties, the sources of funds are obviously on-source revenue, equitable share, and the conditional grants, as well as any opening balances. And the uses are obviously money that goes to recurrent spending, as well as development spending and any closing balances. So we had 4 panels, and this is just an extraction of the entire panel. And what this shows is that it basically shows the implication of these delays and the uneven release of funds and the budget revisions, the implication it has on county budgets. And there are 2 things that we see from this. The 2 stories that we see from this is that by and large, spending at the national level or national government spending is maintained, or national government budgets are actually maintained. But this is actually contrasted by the fact that we have a squeeze on the transfers to the counties. And the second bit being that we have cutbacks in county spending. So this data basically shows that, the one that we've highlighted in red. And so, of course, we have absolute figures as a share in terms of the uses for the 2 levels of government. And we have these figures as a share of the total uses or total expenditure, and the same as a share of GDP. Now, I may have picked the wrong slide. Yeah, I picked the wrong slide. Allow me to pick. I think I picked the wrong slide. But the effects, because I have the figures. Just call me 1 minute. But these are actually the fact that the two that I summarized, and I just want to show you the figures that there's a declining spending from 2014-15 to 2019-20 for county governments actually reduced. So you will see that declining trend, both as a percentage of national spending as well as a percentage of GDP. And also that squeeze, as demonstrated here, I don't know whether you can see the cursor. So for instance, total county transfers to counties, the equitable share actually has been, as a percentage of total users, has been going down from 14.1 to 9.8. So this is what we are referring to as a squeeze for county government, county transfers. And the same applies if you look at it from as a share of GDP. Then actually at the county level, if you split recurrent versus development, the situation is worse in relation to development. So you can see total users, which is basically spending in terms of development programs at the county level, has actually been going down from 20.9% as a percentage of total users or spending at the county, going down from 29.7 to 24.8%. Sorry, I have the slide with the figures now. Let me just stop sharing this, then I can quickly. I think I picked the wrong slide.
No, you didn't.
No, I have the right slide. Sorry,
That's the right slide.
Just 1 minute.
Right.
Just 1 minute. But I'm concluding. But basically, it shows the picture. Let me see whether you can see this. Just 1 second as I download the right. So that panel of, and of course my colleagues can chip in as I think it's opening. Just give me 1 second. This was the right one. Yeah, this was the right.
Right.
Oh dear, what's happening? Seems it's the wrong one as well.
That's the right one.
Just, I don't know. I picked the wrong slide, but this. I didn't print. So just 1 second as I try to upload the right slide. because I'm concluding. But basically, those figures are shown in the. I don't know, I have the wrong slides. It's just that the last 3 slides, of course, are the key messages, and the figures just to show the squeeze in county transfers as well as the cutbacks in county spending or county budgets.
Okay, John, because you have, I mean, those key messages are very important. So just take your time and find them. I mean, we can hang it a couple of minutes, so you take your time and find them.
Just 1 second, yeah, as I'm. Just 1 second. Sorry.
John, can you hear me?
Yes, Javi, I can hear you.
I think the slide is okay. You just have to put the slide up again.
So it's uploading.
Okay.
No, it has the figures. It's just that there's some.
I think we just have to talk about them in the right way. Put up that sources user slide again.
Yeah, that's 1 minute. No, let's open it from your end.
Yeah, stop there. Here's the
This slide,
point.
Yes, it's the next one, John. Just go ahead. I think this is correct.
If you look at total spending at the national level, it stands the top line. Go to the top, back to that chart, back to that slide. It's been maintained as a share of total spending. That total spending is the same, and it's maintained pretty much as a share of GDP. It goes from 24% to 24.8%. It goes down a little from 1920 compared to 1819, but it's pretty constant. But if you look at the equitable share, how much they actually provide by the national level to the county level, that percentage of total national spending goes from 14% down to 9.8, less than 10%. And the equitable share as a percentage of GDP goes from 4% to 2.8%. So that money is being spent for their own programs at pretty much constant level of GDP. But the money that they're providing to the counties has constantly declined as a share of GDP. And if you look at county spending, you can see that recurrent spending has only fallen a little bit relative to GDP over this period. But the development spending has really gone down quite a bit, even though it was pretty low to begin with. By the end, it's like 80% of what it was, 2014, 15, and 2015, 16. So it's clear that the national government is maintaining its spending, but the county governments are finding their spending squeezed because the money is not coming in to keep up with GDP. As far as the equitable share is concerned, look how that's fallen, 4%, even before the pandemic, the 3.4, that's a big change. But the national government's maintaining its spending and the county government's not able to do so, particularly with respect to development programs, which provide for the future growth and development of the county level. So that's the story that we're telling.
All right, John. So go ahead.
Thanks, Harvey. Yeah, sorry, I've gotten the right presentation. But yeah, thanks, Harvey, for that. Summary of what that table shows. I hope you can see. So initially, so that's the table, and it's an extraction actually from the entire table. And this is the summary in the sense that national government is actually maintaining its position in spending. Looking at those figures, you can see 85.7. That is spending at the national level as a percentage of total uses, which is your total spending at the national level. That is more or less actually went up, showing that national government is actually maintaining its budget and spending, both as a percentage of total spending as well as a percentage of GDP, despite a slight drop in 2019-20. The squeeze, yeah, Javi has actually shown this, but these are basically the figures. So equitable share again, has been, you can see it dropping from 14.1 to 9.8 in red. And then both as a percentage of national spending and as a share of GDP. GDP from 4.4% to 2.8. Then these are the specific effects on county budgets. County budget as a percentage of national spending dropped again from 26.3% to 21.1% for those 6 financial years, with an exception of a slight increase in 2018-19. Again, there is decline in county spending as a percentage of GDP, 4.5 to 3.8. Looks quite small, but you know, of course, GDP it's a huge whatever. This basically implies that spending at the county is not keeping pace with the growth of the economy. And the situation is even worse in regards to spending on county development spending as a total of county spending, 29.7% to 24.8%. So in terms of key messages, as I summarize, in way of summary, revenue underperformance. So we saw that when the first slide that shows the trends between revenue projections and actual revenues, as well as the errors in estimation of revenue, are actually mutually reinforcing or complementary in terms of contributing to undermining the objectives of government decentralization process and structures in Kenya. So those two issues actually have a dire effect in terms of the decentralization program in Kenya, in terms of affecting it negatively. The second key message is that funds from the national government to the counties are not keeping pace with GDP and are being delayed. So the aspect of delay was quite clear from the data that we showed. And the third one is that budgetary spending at the county level is being delayed and is actually declining relative to GDP. And the final one is that there's a disproportionate burden actually in terms of spending on development programs that are actually the most affected at the county level. Now, based on this, we have like two key recommendations. The first one, actually to the National Treasury. We know there's been a bit that is been going on at the National Treasury in terms of trying to address the issue of revenue forecasting and just accuracy around that. And so what we are noting is that there is need for Treasury to explain the reasons for past revenue forecast and also indicate the reasons why the current forecast, why they've not been able to contain this current forecast, because the idea is that there's need to learn from, there's expectation that Treasury should be learning from the past revenue forecast errors. But we see that these errors, actually for these financial years, have not been reducing. And one would actually expect that for the budget forecast errors, this should be lower than the BROB, because by the time we are doing the budget forecast, we have more information. We have information on tax policy changes and the like. But we see that these errors continue, or that the errors are actually pervasive, both in absolute terms as well as as a ratio of GDP. And the second recommendation is that, of course, there is need for oversight on this. Sorry, on the first, of course, we know that the Treasury has a tax policy unit, and the idea is actually to be able to build the capacity for to address the issues of revenue forecasting. But there is need to explain this to the public, and Budget and Appropriation Committee of the National Assembly should actually question Treasury on this forecast and get an assurance that these errors will not continue in the current budget, of course, both as absolute forecast as well as a percentage of GDP. So there's a role there that, of course, the Budget and Appropriation Committee, I think in the next, once the budget policy statement, they will be reviewing that statement, and we expect that they should be asking these hard questions around revenue forecasting, because if we don't address them, we'll continue to experience and some of the things that we've shown, and it will continue to have implications on county budgets and spending at the county level, and obviously this will affect development outcomes at the county level. The third one. The first two are obviously related to issues of errors in revenue forecasting, and the third one is basically related to issues of spending. There is need for the national government to actually find some or consider some mechanism to ensure that whenever we have these issues, that this mechanism will actually maintain the equitable share to counties at a constant ratio, just like that is maintained at the national level. And the panel of data actually showed that there's that squeeze. So there's need to find a mechanism that whenever we have some revenue shortfall, it's the counties that are bearing the brunt. So that the transfer should actually, what we see being maintained at the national level should actually be maintained at the county level. So those are our three key proposals. Yeah, thank you, and I welcome questions and comments from our participants. Thank you.
All right, thanks a lot, John. Let me just try and say two things to summarize. One of the things is that I think the first thing is that the government of Kenya, or rather let's say the Treasury or the Finance Office, the Ministry of Finance, the National Treasury has forecasts on the budget, and these forecasts or whatever model or whatever tool they use generates errors, and those errors are consistent over time. And they're not only consistent, they'll be getting worse based on the data that John showed us at the early day. So what that suggests is we then ask the question, rather John then asks the question, what kind of effects would that have for county level budgeting? And he finds that one of the things it does, obviously there's volatility because there are delays in sending the money, but not only that, there's just the volatility. Looking at the at the county government budget level, there's between the recurrent and the development expenditure, and many Kenyans seem to agree that what county level governments should do, devolution should have done, is actually led to the investment in services that people demand, whether it's health services, agriculture, or whatever. Now, these data suggest to us that because of that, those errors feed into the frequency in which county governments receive money and that volatility, and what then that county governments make the adjustments by making recurrent expenditure more stable, but then make adjustments by a reduction or reduction in development expenditure. So that's one, and I think it has definite outcomes for people's welfare. So that's a first. The second is that budget spending obviously is not keeping pace with GDP. And as we've seen, one of the things that is also very, very clear is that most of county governments have not only seen a reduction in the overall amount of money as a share of GDP that they receive, but also as a share of the total revenues that are collected. And this is such an important argument because the general view in Kenya, or the perception, is that actually county governments receive so much money and most of it is wasted. And that depending on which cynic you meet, the argument is that has devolution paid off, or has it justified its existence? So I think what John tells us is that this is a far more complicated story when you look at this granular level and you follow the thread right down to the bottom. That this is a far more sophisticated story than to simply say that county governments have not been as effective as they should have been. The argument about the redistribution of revenues as required by the Constitution is one that I think this study resurfaces, because it says the claim by the Treasury generally that actually transfers to county governments is keeping pace with the economic growth on the one side and total government collection on the other is actually proved not to be correct. So I think using this evidence again, there's an opportunity for discussions about why that perception exists among the public, the media. At least we see that corrected, and John mentioned one press statement that has referred to that. But more importantly, to put this up. Now, I don't intend to repeat what John has said, but these are some of the things that stuck with me, and he gave some recommendations up there. So one of the things, what we'll go to right now is to ask whether those who work with John, whether Noah or perhaps Harvey or Rihanna have other comments to make before we can open up this discussion for your question and answer. Is anyone, Noah or Harvey? Harvey, do you have any comments to make before we can open it up to the audience? Okay, thanks. Noah, do you have any comments? Would you like to add anything? All right, looks like everyone's satisfied. So let me open up this discussion now to questions. So you have a tool. Please raise your hand. I will be able to identify you and ask you to state your name and ask your question, and John will respond. Anyone out here? Any questions? Well, I don't see. There's a chat box as well, which allows us to run a conversation. So if you have a question that you'd like to answer answered, please send it either by form of a message, which I'll be able to see and read out to John. Okay, fine. There's Abdiraham. You have your hand up. Abdirahman Gorod, please ask the question. Thanks a lot.
Yes, thank you so much, Kwame and team. My question is twofold. Hello?
We can hear you. Just go ahead. Please go ahead.
Yes,
we hear.
Thank you. Yeah. So on the delays, it seems that the counties are, from the presentation, they seem to suffer from a delay of releases as far as the approved allocations is concerned. So in my view, or my question will be rather, what is the role of COB in ensuring that there is consistent disbursement to counties? What is basically their role to ensure that they follow the cash disbursement schedule, or rather they bring some fair play in terms of releasing or resourcing counties as per the approved levels? That's my first question. Second question is The graph has indicated that consistently, the development allocation for counties is around 24-25%, but less than still 30% the required ratio. That notwithstanding, the equitable share is still increasing, but the development share is not increasing. So what could that be? What could that mean? That perhaps 5 or 6 years down the line, we are still funding recurrent allocation, that we don't seem to be somewhere at optimal level, or what could be the implications? Thank you so much.
Right, thanks, Abdirahman. John, could you please respond to those two? So the first question was basically, what role could the COB play in ensuring that there's certainty in the transfers? And the second one is just basically how counties are responding by expanding recurrent expenditure, but actually reducing as a share of total spending the development component. John?
Yeah. Thank you, Kwame. Thank you, Abdi, for that question. Yeah, COB actually authorizes releases based on certain requirements. So first, what we've tried to show is that there are delays in terms of money being released from the national to the counties. But now from the county, so from the county revenue fund, there are certain requirements that the county treasury is supposed to meet. There are certain things that they are supposed to do when they are making requisition or when they are requesting for cash, for funds basically. And these requirements are actually outlined in COB requisition. There's something called a requisition document. I'll get the right words, but it's some cash requisition document. And it has certain requirements. For instance, at the beginning, in the first quarter, these counties must have their, of course, CIDP in place, their approved budget in place, among other requirements. And those ones are actually outlined, and we can share that document with you. Now, it's basically a checklist that actually COB follows to check whether each respective county has met those requirements before funds are actually released from their county revenue fund. But the main story that we've tried to show is the challenge that we have from the national to the county itself, the fact that we have those delays, but there are also other delays that actually arise from once the money has hit the county revenue fund at the central bank, from that account to operational accounts for counties to enable them to implement their work plan. And actually, the disbursement of funds is, according to the Public Finance Management Act, supposed to follow cash disbursement schedule. And based on our interactions and interviews with the county officers, we noted that this rarely happens. And you can see the genesis of the challenges of not disbursing money according to the Senate-approved cash disbursement schedule start from the revenue forecasting process. And sometimes the delays in division of revenue allocation bill also come into play. So there are basically things that are external to the counties that lead to delays, but internally we also have certain administrative things that counties have to meet, all collectively that will determine the timely release of funds. The second part, so Noah can answer the second part of the question, Kwame, if you don't know, and add to the first question.
Yes, first I would like to add on the first question regarding the delays. So we did analyze the quarterly inflow of funds at the national level. And what we see is that we do not, I mean, the inflow of funds are fairly even across the quarters. But then when we look at the delays at the counties compared to the delays at the national level, we find that the delays are much more compared to inflow of funds. So what we find is that while the inflow of revenues at the national level, they're fairly even, there's much more delays at the county level compared to at the national level. And so, yes, John is right in terms of the items that control of budget looks at before approving of funds. But then we find that most of the counties are actually meeting these thresholds. Yeah, for example, they'll require the approved budget, the CIDPs, but we find that most of the counties at least are meeting. For all these 5 years, we only found 11 counties that did not meet. Yeah, 11 counties for all the 5 years, which means most of the counties were meeting these requirements. But then what we note really is that national government is withholding funds to itself, to its ministries and ministries, departments, and agencies, and not dispersing all the funds to the counties. I mean, timely dispersing the funds to the counties, leading to much more delays on the counties compared to national government. Yeah.
Okay, thanks, John and Noah. I have another question from Joanne Onyango, and I'll read it out because she says, a lot more money should be devolved to enable adequate implementation of devolved functions. At these rates, there seems to be a deliberate effort to hold funds at the national government, while services are provided at the county governments. So the question is what is the connection between county and national governments planning processes? I think that's in respect with to service provision. And I mean, how does the planning at county level feed into the national planning process to enable proper budgeting? So I think that's a process questions around the PFM and service delivery. So maybe John and Noah, please go ahead.
Yeah, thanks, Joanne, for that question. So there is actually the planning and budgeting process at the county level mirrors what happens at the national level, with some slight delay, at least, or some leeway at the county level, especially with regard to preparation on when they should submit their county fiscal strategy paper, which is like your pre-budget statement. But otherwise, all the counties, I mean, the counties at the national, the counties should ensure that they have their annual development plan that is actually based on the county integrated development plan. The country in general, of course, is guided by the Vision 2030. So what the national government does in terms of planning priorities is guided by that, and the same goes to the counties, of course, based on the functions that have been devolved, health, and among others. And so annually, the national level as well as the county, respective counties obviously develop their budgets. And this process actually starts in August every year. And the preparation of the budget goes on to April. So by end of April, the Treasury at the national levels and the respective county treasuries should actually submit their budgets to the respective assemblies. And then this should be approved by end of June to allow for the beginning of budget implementation from July 1st all the way to the end of June of the following year. So you can see how these two, how the two processes actually are similar, and there are certain things. For instance, the issue of the main one, and I can see that's maybe what your question is based on. The main one is the issue of division of revenue between the two levels. And this is actually based on certain, of course, recommendations that are made by CRA. And there's a bill that is prepared to that effect, the division of revenue bill, which is, of course, discussed by the two houses of parliament, which culminates into its passing. Now, whenever there are delays in passing of the division of revenue bill, that has an effect. And we know that there's always been a contention between the recommendations by CRA vis-a-vis the recommendation by the national government. And that contention, as we've seen in the past, with the exception of last year, is one of the things that has led to delays in the release of funds. And that somewhat tends to affect the budgeting process for counties. And we've actually explained some of the things that are related to the Division of Revenue Act. So that's basically the connection between the two levels in terms of planning and budgeting, and how they feed into each other.
Okay, thanks, John. I haven't seen any other questions, so I'm wondering if anybody else has their hand up. Let me just see whether there's anybody else with no, I don't see anybody else. So let me just ask, does anyone have any other question? So please raise your hand.
There's one from Ringine.
Okay, well, I can't see it. So can you see it, John?
Yes, I can see it.
Okay, please read it out.
I can read it out.
Yeah, please do.
And then we will respond to it. So Ringine is asking, what are some of the available options, tools that counties may utilize in mitigating these implications? I mean, the implications occasioned from, for instance, revenue forecasting errors and the stuff that we've just discussed. Let me see. So the first one is just basically one of the options or things that we noted in the recommendations is obviously a question of National Treasury improving its accuracy on revenue forecast. As I mentioned, we know that there's some effort in that regard. We already know that there's a unit, tax policy unit, that was established at the National Treasury, and the idea was to enhance the capacity and staffing and around improving revenue forecasting. But we are also aware that there are certain political economy questions when it comes to revenue forecasting. Clearly, the issue of our optimistic revenue projection in a way disguises budget deficits, makes them look small, and ensures that spending at the national level is maintained. So that's one of the political economy questions around overestimation of revenues. There are also maybe questions around the model that is used in revenue forecasting, questions around. So basically, this is a transparency question, and it's something that the Institute of Economic Affairs, together with Urban Institute, we've been engaging with different organizations, mainly those that comprise the macro working group. But one of the things that we are calling for is the need to be transparent. And the idea of developing our own revenue forecasting model is to enhance the discourse and transparency around issues of revenue forecasting, because there are questions around the assumptions that were factored in computation or estimation of revenue. So I think once we have those two things right, and enhancing the discourse on revenue forecasting, as well as the credibility by CRA to also be a major player in this will be a roadmap towards addressing the implication that this has on county budgets and spend. Yeah, so I would say that's one of the options or tools. Obviously, the other one is the need for enhanced or effective oversight from Parliament, and in particular the Budget Committee, on matters to do with the, as well as Senate, on division of revenue process and just budgeting in total. Kwame, no, I would like to chip in as well.
Yeah, thanks, John. And I would like to add on the issue of national government tending to withhold more funds to the national ministries, are not, delay funds to the counties. And one of the issues that actually government is now grappling with is the issue of public debt. And we see that while the total revenue, the total expenditure by the government as a share of GDP has remained almost constant, the share at the counties has been declining. So the issue of public debt and the issue of the total expenditures at the national level has really been maintained, but then what is now being left to the counties is declining over time. For instance, the ratio of county to national expenditure, this is direct expenditure to MDS, reduced from 26% in 2014-15 to 21% in 2019-20. So that's a decline in the ratio for counties. So given that we have already seen that revenues are more or less even across the quarters, there is need, this provides evidence that county governments can use to, in the discourse, public discourse with the national government, to demand more even distribution of these funds at the counties across the years. Across the quarters within the year. So we find that in the first quarter, there's much more delay. And actually, there's much more delay on the development side of the budget, and leading to very low absorption rate on the development. So in a nutshell, counties are being affected in terms of public service delivery because of the delays across the quarters. Yeah.
All right. There's one more question now, and John, from Joanne, and she says, does the national revenue forecast take into consideration sources of revenue at county level? I hope you heard that. John, did you hear that?
Yes,
John,
I did.
Okay.
So revenue. So of course, the revenue forecast does not, at the national level, does not, of course, consider sources of revenue at the at the county level. The way revenue forecasting.
Excuse me, John. Yes. There's some feedback from your side. Please make sure that if there's someone with you in the room, that the microphone is switched off.
Okay. Yeah, thanks. Sorry for that. So revenue forecasting is based on basically it looks at is actually based on the key key taxes, the 4 key taxes at the national level. We have income tax, VAT, trade taxes, and excise duty. But the idea is to look at the different components of the economy and the ability to which they are able to generate these revenues. So the variables that go into revenue forecasting are these macro variables related, for instance, economic activity, GDP basically. And you have the different sectors, and there's a way the computation is done. So it doesn't consider county-owned sources of revenue in computation of the revenues at the national level that would then be shared between the two levels of government. Yeah. So the on-source revenue at the county level is obviously generated from as provided for in the Public Finance Management Act. We have two taxes. We have property taxes and entertainment tax, which, as of course, for most of the counties, not necessarily, I mean, they lack a legal basis for collection of entertainment tax, so there are questions around that. And then the rest is basically levies and fees on things like, of course, licenses for business permits, marketing or advertisements, services that are offered at the county level, provision of water, parking fees, etc. All those are comprise sources of revenue at the county, and they're only for the county, so they don't form any basis of the national revenue forecasting. Yeah. I hope that's clear, Joan. Thank you.
Yes, that is. Okay, John, I don't have any other questions. So I'll allow you each to, unless there's another question or there's no question on the board, and I haven't seen any other hands up. So I'll ask you each to make some concluding remarks.
Yeah. Thanks a lot, Kwame, and of course, thanks to my colleagues, the Institute of Economic Affairs. I mentioned their names, as well as our colleagues from Urban Institute, Harvey and Rihanna. As a way forward, we will, so we have this paper that is currently in draft form that basically presents most of the stuff that we've discussed. Firstly, on the revenue forecasting model, there are certain challenges that we've experienced in terms of accessing data. But we believe once we have everything together, we will be able to use that to engage with the CRA, and the idea is to engage with CRA and use that in terms of influencing the division of revenue process, and basically elevating debate around that process, as well as using that to enhance transparency around revenue forecasting. So that process is ongoing, and you can look out for it. We'll be having certain targeted engagements on the same. But on this other side, in terms of looking at issues that affect basically budget execution at the county level, we have a paper that will be concluding in less than 2 weeks' time, and again we'll launch that paper. So we'll have a public launch and targeted engagement on the same. So we plan to engage with the National Treasury directly through a roundtable meeting or a one-on-one meeting on the same, as well as with the Parliament and other institutions like CRA and the like. And so basically, again, look out for that, as well as just discussing this through our different social media pages. So thank you. Thank you, Kwame, over to you.
Okay, so thanks a lot. Thanks, John, and thanks, Noah. So as we conclude, and I'll make 2 comments. One of those is that I think there's an enduring discussion in Kenya. It's part of the BBI process as well, and the Constitutional Amendment Bill, about whether county government receives sufficient resources based on the equitable share and the rule that is required by the Constitution, established by the Constitution, and re-emphasized in the Public Finance Management Act. So the hunch that we had when we started this project was that the idea, it might not be very clear to the public and those who make these decisions about what kind of resources are available and how those resources are distributed. So we tend to speak about them in nominal terms, that counties have received 300 billion every year. But some people claim that there's no change, and for that reason, we ask what happens. The intention of this project was, among many things, first to actually ask ourselves, what are the forecasting tools that the government of Kenya uses, specifically the Treasury, and to find out to what extent they're reliable or dependable. John and Noah have confirmed to us today that there's a lot to be said about the reliability of the tools. We do not make a decision about whether it's deliberate or not, but we are concerned as the IEA that they've been consistently wrong, and that's actually getting worse as the years pass by. So public discussion around the transparency of those tools in revenue forecasting is essential, and I think that's a case that's been made and confirmed by the evidence. The second point is, what effect then does those errors, whether deliberate or not, and I think for this moment we have no evidence that they're not that they're deliberate, but whatever it is, that tool is very unreliable, or at least it's not as dependable as we should. And of course, there's no tool that is perfect. But if it has consistent errors, what are its effects on the distribution of revenue, and specifically the ability of county governments to actually provide the services that there's a huge demand for and for which they're under pressure. And again, what we see here is that obviously it forces two things. One, the fluctuations and the inconsistency in the expenditure, and the ability to plan and execute project is affected substantially. Even while the evidence shows that there's no problem at the national government level in terms of the fluctuations are not too big around the quarterly estimates of revenue. I mean, the quarterly collections of revenue. So why there's a delay in advancing counties that money, I think report suggests some administrative bottleneck that also needs to be unclogged, or at least for the public discourse to go around. So whether it's at the control of budget, whether it's at the Treasury, whether it's at the banks, or whether it's at county level, county governments not making the returns in time is something for us to investigate further and to expand. But the final one, which I think should be something that for every citizen should concern us, everyone is interested in public welfare, is that the adjustment that counties are forced to take by virtue of the delays and coming down from the poor forecasting means that they're actually dedicating less resources in general to the provision of services. Why? It's easy to understand why the current budgets are actually very sticky. So they go for the easy adjustment, which is basically to cut down on what could be spent on development or provision of services and development, because that's what happens if you have people on the payroll and stuff like that. But also, we know that over the period that John has spoken to us about, the national government's share of total spending has actually been going up at the expense of that of county governments. Now, whether that's a political choice that was made, whether that's a policy choice, is something we wish to alert the Senate on the one side and the counties and the county. I mean, the Senate on the one side, the CRA on the other, and at the same time the National Assembly, whether this is a conscious political decision or whether it's something that's happened by default. So that's the essence of this study, and we're glad that it's generating things that confirming more firmly some of the things that we've thought about, but also giving us new ways in which countries are adjusting to these big differences. And so we hope that it's been useful for all of us, for all of you here, in terms of the education, providing the data. John has confirmed that in 2 weeks we'll have the paper ready, which will be formally launched. But the presentation that John has made will be made available on our website right after this, so that you can link to it, and if you have questions, you can ask back. But I'd like to thank John, Noah, and our colleagues from Urban Institute, Harvey, together with Rihanna, for coming up together, trying to push this, and we're glad that the project is going ahead and providing the useful insights and the information that is useful for the CRA and other arms of government to make the decisions that are consistent with their responsibilities under the Public Finance Management Act and obviously the Constitution in Chapter 12. Thank you very much. Thank you very much. Thank you. Thanks.
Thanks.
Thank you.